Hello, good morning. Welcome to this joint webinar, not a seminar, a webinar, between the Institute for Fiscal Studies and the National Institute of Economic and Social Research, which I'm really delighted to be sharing today. And we'll be looking at what I think is going to turn out to be one of the defining issues of this crisis. As we all know, the economy is in deep recession. That in itself is causing a huge deficit this year. Put that alongside a massive government response, a Rooseveltian response even, and we're looking at a deficit of 300 billion or more this year, and probably big deficits for several years to come as the economy takes a while to recover and government spending continues to remain high in support of the economy. So we are going to be facing almost certainly a period of sustained deficits, of increasing debt, and of governments wanting to work out the right way to deal with those. So today I'm really delighted that we're going to bring together the expertise of NIESR and the IFS to look at those issues. We're going to kick off with Gary Young, who will be from NIESR, who will be looking at the possible macroeconomic scenarios going forward. Then Carl Emerson of the IFS will translate some of that into what might happen to the public finances. And finally, Jagjit Chadha of NIESR will be tackling the really difficult issues of how that might matter, how sustainable those levels of debt and deficit might be. They between them will speak for something like half an hour. If you have questions, then please do send them, email them to events@ifs.org.uk. Please do send those whilst the participants are speaking so that we have a couple to get going with, but also feel free to hold them to the end. And we should have half an hour or so for questions at the end. I'll stop there and hand over to Gary.
Thank you very much, Paul. As Paul just said, I'm going to give you some of the macroeconomic background to the crisis and paint a couple of scenarios for you. So just to start off, as we all know, the outlook is very precarious and uncertainty is massive at the moment. And so what I'm going to set out is a plausible main case scenario, which is based on our last forecast from May, and look at the risks to the short-term outlook, the risks to the long-term outlook, and to emphasize the importance of continued fiscal support through the crisis. Now, the uncertainty we're facing is unusual. It's mainly about the path of the virus and the possible recurrences in the UK and other countries. And the recurrences in other countries is just as important as in the UK because that will affect our trade with other countries. The uncertainty also depends upon how effective social distancing is in the workplace and whether there are future lockdowns. It's also dependent on the extent and duration of government support throughout the crisis and whether the network of physical, human capital survives the shock. So this is the May outlook that we published a couple of months ago. We see this as a plausible scenario rather than a confident prediction. So in the main case, we see GDP falling by 7% in 2020 in the UK and then rising by 7% in 2021 to a level just below where it was at the end of 2019. We don't see any large inflation, but we do see unemployment rising to over 10% by the end of this year, bank rate remaining low, and the external balance improving a little bit this year as trade declines, and we see the deficit rising to about 10% of GDP, which could actually be much higher than that. And as I say, this is not a confident prediction, it's just what we see as a plausible scenario. And it was conditioned on a gradual easing of the lockdown from mid-May, which has largely happened, and no significant recurrence of the virus. But the risks are very large and mainly to the downside. And it's important to say that in this scenario, the government deficit does increase, as I said, and you can see this in the chart of the sectoral balances. The government deficit rises towards 10% of GDP in 2020, but that's the counterpart of that is a household surplus of a similar amount. So the higher government borrowing is being matched by higher private savings. So it's being financed largely by borrowing from those, not directly, but borrowing indirectly from those who are unable to spend. And the national balance sheet as a whole isn't being affected negatively by the crisis. So you have a situation where households are lending to the government. It's not that the government is borrowing from future generations or from people overseas, it's borrowing from citizens who are alive today. Now, since we put that forecast together, a number of things have changed. I think in general, they've changed in quite a good way. So the infection rate has fallen. It's obviously still present in the community, but it's much lower than it was. Lockdown measures have been progressively eased, and they'll be eased again at the weekend, as we all know. GDP turned out to be 25% lower in April and February, according to the ONS figures. The coronavirus job retention scheme has been extended to the end of October, and so far over 9 million jobs have been furloughed by the middle of June, plus 2.6 million self-employed. In the latest, some of the latest high-frequency labour market data, we've seen that there were 600,000 fewer employees in May than March. We know now that around a third of the workforce are able to work only from home. And it's also true that the financial markets are no longer stressed. And that's partly because of the intervention of the Bank of England, but it's nevertheless true that there isn't any financial market stress as there might have been. So in general, I think things have gone quite well over the last couple of months, but there are still risks going forward. Just in terms of the numbers, the GDP per head in the second quarter is likely to be back at around 1999 levels. And although all industries have been affected by the lockdown, some industries have been affected much more than others. So in this chart, you can see what I've plotted here is the percentage fall in GDP from February to April in the sort of burgundy bars, and the percentage of the workforce furloughed in the black bars. And you can see that in the accommodation and food sector, as we know, that's been largely shut down. Arts and entertainment has been largely shut down, as have parts of the travel industry. So the shock has been, the lockdown shock has been a general thing, but it's been focused in particular industries. What are the risks for short-term outlook? You could ask, well, is 25% hit to GDP as bad as it gets? Well, it could be, but it's important to say that the ONS estimate is itself uncertain, and the real number may be a bigger hit. And of course, if you have to have a longer lasting lockdown, then the impact could be bigger in that, because at the moment, a lot of people have been working from home and continuing work that was sort of built up prior to the COVID crisis. If you had another lockdown, there may not be anything for them to do. It's possible the hit could be bigger. In the main case scenario, we have GDP lower by 7% in the second half of 2020 compared with the second half of 2019. With spending largely being affected by lower business investment because of the uncertainty, lower exports because of measures in other countries, and reduced activity in the hospitality, arts and travel industries, which are job rich. And so I think what we might be seeing as we move into the second half of the year is, instead of a general lockdown, see a lockdown affecting a particular sector, but that could spill over into other sectors. So this chart tries to simulate that by imposing a shock, which is specific largely to the private non-traded sector, which you see here falls by 8% in this particular case. That spills over to other sectors because of the reduced spending by people in that sector, and because of the fact that there are these supply chains and the demand for intermediate products into the private non-traded sector. So that shock could then spill across other sectors if it isn't cushioned by continued sectoral support. So I'd see some support for that sector has been pretty important in the second half of the year. In our forecast, in the main case forecast scenario, we saw unemployment rising to over 10% in the second half of the year. Again, that's hugely uncertain. And, we would recommend really that the coronavirus job retention scheme is either extended or replaced, so as to stop people losing their jobs and becoming distanced from the labour market. So in terms of the risks for the long-term outlook, I've sort of put on this slide some of the difficulties in knowing exactly what's going to happen. So If you think about potential output, well, you could get changes in labour supply because of the crisis. Now, it could be that that's a positive shock because people want to work harder to make up for the time they've lost during the crisis. But it could also be negative if people lose their jobs and become distanced from the labour market, so there's that hysteresis effect there. Similarly, there's likely to be effects on productivity. Longer people are not at work, there's less sort of productivity enhancing activity going on, so that's likely to cause a reduction in productivity. But on the other hand, you might see some creative destruction as some of those zombie firms we've heard about finally go out of business. So it's difficult to say exactly what the effect on potential output will be. And similarly, on the demand side, it's difficult to know exactly how that will work through, because as I said, some of the private sector, some people have sort of saved more because of the crisis, and so their balance sheets are healthier, so they may want to spend more. But on the other hand, there's obviously a lot of people who will be saving less and who will have to rein back spending, particularly firms, as they try to restore their balance sheets. There'll also be demand effects from whatever the government decides to do as its fiscal response to the extra borrowing through the crisis. And of course, there'll be spillovers from other countries. So there are risks of demand to supply and real interest rates. At present, they're very low, but it's not impossible to think of them reverting to historical levels over time, and particularly as those real interest rates are not really determined in the UK, although the Bank of England sets interest rates, it doesn't determine them. They're ultimately determined in global markets, so they could go up. On inflation, I think the upside risk should be contained largely by the monetary policy remit, but I think it would be much more concerning if prices started to fall with interest rates, nominal interest rates very low, and that could usher in a period of debt deflation. So the risks are very much the downside there. What I've tried to do here is to think about the effects of some of those long-term shocks. So what if it turned out that productivity was lower by 1% and the NIESR was 1 percentage point higher as a consequence of the premature withdrawal of fiscal support? And these charts show the impact of that in terms of inflation, bank rate, the debt to GDP ratio, the unemployment rate, GDP, and the effective tax rate. So in the model, we have a feedback rule such that sort of targets the fiscal position. So what would happen as a consequence of lower GDP, and I'm sorry that this chart didn't come out, but in the scenario, GDP is about 2.5% lower. Because of a lost tax revenue, then the effective tax rate would have to rise to compensate for the fact that the economy is smaller. And so if you, I mean, the reason for drawing this chart is to say, well, if you withdraw prematurely the fiscal support, then you risk having lower productivity because the economy will be weaker for longer. You risk having a higher NIESR for hysteresis effects. And so you risk having an economy which is much weaker in the longer term than it needs to be. And so you would have to have higher tax rates anyway to pay for all of that. So in summary, the economic outlook is extremely uncertain and depends critically on whether COVID-19 is kept under control. Even without a recurrence, the recovery could be slow and the risk is on a downside. It's important for policy to limit the transmission of the economic shock by continued support for businesses and households. I think that would be particularly important in certain sectors as we go forward. Otherwise, the risk of a significantly worse long-term outlook that could just be as costly as that short-term support. Thank you very much.
And thank you, Gary. So I'm going to talk through what the outlook for the public finances might be, highlight some of the uncertainty when we're looking at projections for government borrowing and government debt. And I'm also going to place those projections in a very long run historical context to ask the question, to what extent is the level of deficit and the level of debt that we have at the moment in the UK unusual? So starting with the deficit, we published some work just over a week ago, which suggests that government borrowing this year could be around 16% of national income. Now, clearly, there's a huge amount of uncertainty around that forecast, but it's not out of line with what other forecasts are suggesting. So we're looking at a very high level of deficit this year. And indeed, if we look back at the data to the financial crisis, we see that the deficit then peaked at 10% of national income in 2009-10. So what we can say is that in the current financial year, there's going to be a very big increase in the deficit between last year and this year. And it would be very surprising if it didn't turn out to be even higher than the peak that we saw back in 2009-10. If we extend this graph back using some fantastic data that the Bank of England have made available, which go all the way back to 1700, we can see that the deficit this year will be the highest level that we've seen since the Second World War. And indeed, it will be the highest level that the UK has ever run outside of the two world wars of the 20th century. So we're going to see a record-breaking level of deficit for the UK this year outside of world wars. So let's look at that deficit in a little bit more detail and see how it compares to what was predicted prior to the coronavirus outbreak. So this chart shows the forecasts that were published alongside the budget in the middle of March before the large impact of the coronavirus on the UK economy had become apparent. March seems an incredibly long while ago now. So these forecasts suggested that the deficit would be at about 2% of GDP this year, rising slightly, but being between 2 and 2.5% of national income over the next few years. So essentially, the government had decided to move away from the previous strategy of trying to eliminate the deficit. It was now relaxed with deficits of about this size, and indeed was going to allow the deficit to rise because it wanted to increase investment spending, and it decided it wanted to finance that with increases in borrowing rather than increases in tax. And it's worth saying that these levels of deficits were kind of around the upper end of what would be consistent with what the government had said were its fiscal objectives at that point in time. If we now take the forecast that we produced just over a week ago, that suggests the deficit this year will reach almost 16% of national income, somewhere in the ballpark of £300 billion. You see that huge increase between last year and this year, but then fall very sharply between this year and next year, before falling gradually over the next few years. But perhaps most worrying in this scenario is not really the size of the borrowing this year. It's more the fact that in 4 years' time, in 2024-25, we would still have a deficit that was running well above what was predicted back in March, more than twice as much borrowing as what was previously forecast. And we can break this path of the deficit down. Loosely speaking, for this year, we can say how much of the increase in the deficit since March is directly attributable to the direct gross cost of the new policy measures that the Chancellor has set out since March. So we've had, for example, the job retention scheme to providing support for employees. There's also been much support for public services and for businesses. And you can see that over half of the increase in the deficit that we're forecasting this year compared to that March projection is directly attributable to those new policy announcements. The remainder of the increase in the deficit is down to the lockdown, reducing economic activity in the UK, which depresses tax receipts and also pushes up spending on universal credit. You can also see that between this year and next year, the large fall in the deficit is in large part because the direct cost of those measures goes away. By assumption, those measures are temporary. They won't have any direct impact on the deficit beyond this year. So there's clearly an issue for the public finances there in the sense that there has to be a chance that some of those measures will be extended. So for example, I don't think it would be that surprising if some of the welfare increases that have been announced for this year don't turn up as a more generous welfare system in subsequent years, at least for some working age individuals. As I said, there's a huge amount of uncertainty, and Gary stressed too, around any fiscal projection at any point in time, and that's certainly the case at the moment. So alongside this central forecast, we also produced two alternative scenarios for how the public finances might evolve. A faster recovery scenario where the economy bounces back more strongly, we see a bigger fall in the deficit between this year and next, and thereafter the deficit's running at a lower level than what would be seen under our central scenario. So this is a clearly much more favourable situation. In 2024-25, the additional deficit that we're seeing over and above that was projected in March would be about half as big as what we would see under our central scenario. Less optimistic scenario painted by the second wave scenario, where there's a second outbreak of the coronavirus in the UK, the lockdown returns, some of the emergency support has to be turned back on, the deficit spikes much higher this year, and again it falls sharply, but runs well above even our central projection right the way through the medium term. Clearly, that's a scenario we want to avoid. And if there's policy action we can do now that can put us more on that faster recovery scenario, then that's policy action that we almost certainly should be taking. So lots more borrowing this year and lots more borrowing over the next few years. What will that mean for the outlook for government debt? Well, just over a week ago, the Office for National Statistics published an estimate suggesting that government debt had just reached 100% of national income. Now, that's almost certainly going to be revised going forwards, but we can see how that compares to UK history. 100% of GDP is the highest level of government debt since 1963. So it's the highest level in almost 60 years. But if you take a longer run view of history, you can see that it's often been the case in the UK where the debt to GDP ratio was above 100%, and in many years, well above 100% of GDP. So on average, in total over the last 320 years, you can see we've had a debt to GDP ratio of above 100% in 131 of those years. So unusual by the standards of the last 60 years, but not unusual by the standard of the last 320 years. So what about the debt to GDP ratio going forwards? Well, if again we just go back to March and we look at what was forecast alongside the budget, and I should stress this is a measure of government debt which excludes the temporary impact of some of the loans that the Bank of England had been making to the financial sector. So this is a measure of underlying debt. And you can see that at the time of the March budget, the forecast suggested that this measure of debt would essentially remain flat over the next 5 years. It would no longer be falling as it had been in previous years. So on this measure of debt, it was already very much touch and go whether the Conservative Party manifesto commitment to reduce the burden of debt to GDP over this Parliament would actually be met. Well, that manifesto commitment is now pretty clearly for the birds. The debt to GDP ratio is going to increase sharply this year with all of the government borrowing that we're doing and also the reduction in economic output in the current year. Under each of the scenarios we set out going forwards, you can see the debt to GDP ratio continues to rise. So even after the deficit drops back down next year, there's still enough borrowing and there's still not enough growth in the economy to ensure that the debt to GDP ratio falls. Even under our faster recovery scenario, it's edging up, albeit relatively slowly. Now, of course, it's important to remember that one of the issues with debt is how much you're spending on servicing that debt. And at the moment, that's incredibly low. If we take that fantastic data from the Bank of England, that allows us to look at how much debt interest spending has been as a share of government revenues going right the way back to the late 1600s. So this is essentially showing to what extent are we having to spend tax income on things that we don't really want to be doing, i.e. paying debt interest charges, as opposed to spending on things that we might much rather have, such as transfers to households in the form of money or quality public services. And you can see that we entered this crisis with the share of tax revenues taken up by debt interest payments at their lowest level for 320 years. Now, going forward, it's certainly the case that we're going to have a much elevated level of debt, but it's worth remembering that under all three of the scenarios that I just set out, our estimates suggest that we'll actually be spending less on debt interest than was forecast at the time of the March budget. That's because despite all this extra borrowing we're doing, the fact that the government can now borrow even more cheaply than was expected back in March more than counteracts that effect. So it's depressing the amount that we spend on debt interest by more than the extra borrowing is adding to the debt interest bill. So I'm going to conclude with some thoughts on what this means for policy going forwards. Firstly, it's pretty clear that the lockdown with large parts of the economy shut down and the emergency support that the Chancellor's announced, the extra spending on public services, the extra support for businesses and for households is all going to push borrowing up this year to the highest level that we've ever seen in the UK outside of the two world wars. Now, as the lockdown eases, as the emergency support is turned off, it's pretty clear that the deficit will fall back towards its pre-crisis path. The key question really is not how much borrowing we're going to do this year, it's more about to what extent will borrowing drop all the way back to its pre-crisis path, or will it remain elevated for some time as the economy takes time to adjust? You could imagine if unemployment rises, if businesses that would otherwise be viable go to the wall, you could imagine the deficit staying higher for quite some time. The extra borrowing is going to push up debt to levels that we've not seen in almost 60 years, and it's going to remain elevated for many, many years, for decades to come. But at least for now, it seems likely that debt interest costs are going to remain below the level that was forecast pre-COVID. And in a moment, Jadjit's going to turn to talk about some of the risks around growth and debt interest charges going forwards. So what are the key questions I think we need to be asking? And in particular, what does the Chancellor need to be considering as he prepares for his summer economic update that he's going to make next Wednesday? I think the first one is there more that the UK can do now to try and strengthen the recovery? If it's the case that we can do tax cuts or spending increases now that we're very confident would lead to a stronger recovery, would put us more like that faster recovery scenario, then that's almost certainly borrowing that would be worth doing at the moment, given the low cost of that borrowing. And I think the second question is much more one for what we should do once the crisis has passed. Once the economy's got back to what feels more like a new normal, to what extent should we consider tax rises? For example, because we want to try and push borrowing back towards its pre-crisis path, because we want to try and manage down the debt that we've accumulated in the last, that we're accumulating at the moment. And also, do we need to push up taxes to try and finance any new desired increase in spending? So, for example, the Prime Minister yesterday spoke about the desire to fix social security, spending on social, to try and fix social care, which may well require more spending in that area. So with those in mind, I'll now hand over to Jadjit, who'll talk about the long run debt risks.
Good morning. Thank you, Carl. Thank you, Gary. Thank you, Paul, for arranging this. This has been a wonderful seminar. So on. I'll just share my screen, if I may. There we are. Hopefully that's working. Good morning. I'm absolutely delighted to join up with our friends at IFS this morning and talk about what are in many ways some very worrying times for the British and world economy, mainly because of the health shock that is affecting us all in many ways. And for us to consider broadly what the obligations are from the state, the public sector in all of this, to consider the responses that have been made and what we ought to be looking for as we move ahead. As Carl rightly said, there's a summer statement of some sort next week. I'll talk about what sense I think that makes of the situation we're currently in. But in the 10 minutes or so I have, I'll try and outline some of the research we've been doing at the Institute, often in cooperation with our friends at the IFS. This work draws upon things that I'm doing with Bill Allen, formerly of the Bank of England, Philip Turner and Pradhan at the Bank for International Settlements. Some work with Adrian Pabst funded by the Nuffield Foundation on how we should confront uncertainty using fiscal policy, and some work funded by the ESRC on risk in debt markets, which I've been doing with Corrado Macchiarelli and Cyril Linoel at NIESR. So let me see if this works in terms of moving on. It does. The classical way to think about public debt is the question of sharing risk with future generations. As Gary said right now, in the middle of the depth of the recession, the debt that we want to issue this year can be largely financed for this year only, from selling debt to households that are saving. But typically, given the maturity of debt, on average in the UK, that's 15 years, we're issuing debt over the very long run. So we are sharing the obligations of paying back that debt with future generations. And that's a critical question for any government to face. As Carl also said, how much do we raise current taxes, or how much do we increase borrowing and place the weight of adjustment on those future generations? It's a critical question that comes up time and time again, and I'll come back to my response to that question shortly. Control of debt is clearly important. It fosters efficiency in the provision of debt. That means efficiency in the provision of public expenditure. There's a point often missed in all of this. One of the reasons you want to control debt is it maintains your capacity to respond to future shocks. We don't know in the world of uncertainty what kind of shocks will come along. Nobody this time last year was worried about, particularly about a health crisis, leading to the largest contraction most of us have ever seen in our lives. And yet it's come along. So what we have to do is think about frameworks that allow us to respond flexibly and adequately to these shocks when they happen in such a way that doesn't undermine the stability of financial markets and doesn't lead to issues about the ability of the government to finance those levels of debt. In that world, economics literature is very clear. The large expenditure shocks that we are currently experiencing, and we have many times in the past, as Carl's charts showed very clearly, need to be met by tax smoothing. We don't need to see taxes rise immediately in response to that. They're distortionary, They may affect the supply of labour, as people may decide not to go to work if taxes are going to be raised immediately. And typically the right way to do this is a very careful process of tax smoothing. And that might then lead you to question, how have we reduced those large levels of debt that we've pointed to in the past? Well, we can analyse that, and we can see that what typically happens is that governments have adopted a path for sequences of fiscal surpluses when they're appropriate. There can be primary surpluses or overall surpluses that include debt interest, and allowed nominal GDP growth, that's the real growth in the economy, and some inflation to increase as the denominator. So a capacity to pay back debt, which of course is the ratio of public debt to GDP, is better if nominal GDP is growing more quickly. What we need is to think very hard and carefully about a social objective for fiscal policy. What do we think we want it to do? We can draw a list. We want it to fill in the gaps of public goods. We want it to lead to sustainable levels of investment in those bits of the infrastructure that are absent. And we need it to be able to respond to shocks when they come along. And this implies, once we start thinking about it, a fundamental reform of how we set the instrument. That is, the fiscal surplus, taxes, revenues and expenditures, a timetable that can be stuck to, that recognises inherent uncertainties. I'll go perhaps a little bit further than my other colleagues on the panel today. Just to say we'll have a summer statement next week, I don't think is enough. We're in a huge level of uncertainty about the economy. Nothing is as we thought it would have been 3 or 4 months ago. And yet, unless we have a substantive statement about where we think the economy is, I'm afraid we're just going to be jumping from policy statement to policy statement without understanding the whole of the framework. And I apologize if I'm going further than the views of some of my co-panelists there. Let me illustrate that point simply by pointing to what happens to revenue to GDP. We've got those nice charts that Carl was looking at. And of course, what happens is that during these processes of large wars, the vertical bars there represent those very large increases in debt that Carl was talking about. We see some tax increases. Of course, income tax itself was introduced during the Napoleonic Wars as a temporary measure, is famously told. And we see some tax increases as well after both World War I and to a degree, at least a stabilization at a higher level after World War II. And what we haven't seen after either the great financial crisis and so far in the middle of the crisis we're currently living through is some extent or reform or consideration of the overall tax regime and how that will raise the revenues ultimately, not immediately, but ultimately to meet the demands of the state that I think we all have in the back of our minds. Let's look at the debt consolidations in the immediate post-war periods of World War I and after World War II. Years after World War I, the early part of the 1920s were characterized by a further great slump. So if we start that in 1923 to 1930, there was a 18% fall in debt to GDP. And the contributions we can decompose as opposed to increase in output, the effect of inflation, interest payments I, or fiscal surpluses. If you've got a fiscal surplus, you're reducing debt, and that's why there's a minus sign in front of it. We can see there is that there were huge surpluses in that 7-year period that matched the interest payments on the debt. And that meant that providing output was greater than inflation, debt to GDP fell in that period. And similarly, in the solid 10 years after World War II, 1950 to 1960, a huge contraction in debt to GDP. And we can see a fair contribution from all the factors there. Nominal income, output and inflation are growing at some 8% on average a year over that period. Interest payments are large, but they're matched by the fiscal surplus that then allowed the debt to GDP ratio to fall. So we have a number of instruments at our disposal. We want policies that help sustainable growth. We do want to control inflation. A third of our debt stock is index linked to inflation numbers. As Carl said, interest payments are low, but we would ultimately want the primary surplus before we pay interest payments to meet that level of payments on the debt that we have. And that's a sort of formula at the back of our minds when we're going to be thinking about a debt consolidation. So what are the costs of funding at the moment? Well, it's well known they're on a secular downward trend. Here we're showing 10-year government yields in the UK, Germany, and the US. And we can decompose those into what we call risk neutral yields, those that don't have risk premium in them. And we can see they're very low by historical standards. My colleague Bill Allen has looked at the period of the 1950s and says that the interest rates were fixed there around 2% for a very long time. The state had tremendous capacity at that time as well, because the maturity of debt was long to meet the extra financial requirements of setting up the welfare state. And these might be the kind of things that we might want our politicians to be thinking about now as well. Risk neutral yields are low. That means the cost of financing in the absence of risks are very low by historical and international standards. That gives what economists call fiscal space to act. And furthermore, if we look at the term premium, those things that are outside of direct control by the government tell you how much more compensation financial markets want for holding a particular asset, they've also been in decline, very much a consequence of the kind of policies we've had in place. But we see term premia are around zero as well at the moment. They've been in secular decline since the kind of QE operations we've seen around the world. This means the cost of funding is historically at very, very low levels. Who's holding UK debt? Well, this is a decomposition showing who's holding UK debt. You can see that the Bank of England has become a large player since QE started, holding some 30% of debt. There's still a very large fraction of debt that is held overseas, and otherwise it's held by financial institutions. So when we start thinking about fiscal space, it's important to understand who is holding the debt and under what circumstances they would wish to continue to hold that debt. If we had a perfectly elastic demand for debt, we wouldn't necessarily have to worry about the kind of debt levels that both Carl and Gary have been alluding to. But if, on the other hand, financial markets and the participants in the fractions I've showed here started to worry about that, we're going to see two effects. One is that the risks premium that I've looked at just in the previous chart would start to rise, and that would increase funding costs and squeeze out government expenditures, and also would make the refinancing of debt more problematic. If debt is some 100% of GDP and its average maturity is some 15 years, that means in any 1 year, some 6% of GDP has to be refinanced. And if international financial markets don't want to hold that debt, we may find that rollover risk being problematic if we don't have a more robust framework in place. But so far, the news is good. If we look at bonds outstanding across the world, and we look at the currency composition of those bonds outstanding, by far and away, the world's most important vehicle currency is the dollar, some 60% of bonds outstanding. The euro is coming up, perhaps not as fast as it was originally anticipated, but it's coming up as a major player. And sterling has remained solid at around 5 to 6% of the currency composition of bonds outstanding. So to the extent to which sterling continues to be an important vehicle currency, we also have what might be called a form of advantage there in terms of continuing to issue our debt to financial markets. I'm grateful to Philip Turner at the BIS for these numbers, providing them for me today. So what's that all mean in terms of debt dynamics? And I want to finish on a point of uncertainty. As both Carl and Gary have done, we can simulate lots of paths for debt dynamics. I started at 100% because that's the number that we're told we're currently at. There's great uncertainty over that number as well. And the key thing to think about is that these dynamics over the next 50-year period really depend upon a small number of parameters about which we have a great deal of uncertainty. The long-term level of growth in the economy, the extent to which we maintain an inflation target, the sequence of deficits or surpluses that we run, and the cost of financing. And if I decide to take poor draws on those, low growth, a long sequence of deficits, and relatively high financing costs, I get the upper line. I get debt exploding to 200% or more over time. On the other hand, if I take a more benign view of those things, and I sort of imagine growth will be a little bit higher at 2% or so, inflation doesn't cause any problems for debt service, and deficits are maintained or on average about 1% or so, and costs of financing don't rise, then we see the kind of decline that we've seen typically in the early part of the 19th century. A long period of stability allows the denominator of nominal GDP growth to make the level of debt we've got more affordable. But let me draw attention to what might happen if there was a second spike. If we model that, we get a jump up in the debt stock in the way that both Carl and Gary have alluded to. And if we had another spike later on, debt rises even more. So one way to think about these things is, yes, they're scenarios dependent upon a very small number of parameters, but about which we have a high degree of uncertainty. And that means projecting forward, we have to accept that we don't really know where debt is going to be. There's a very large boundary when we start thinking in very reasonable terms about where debt might be. I can't pin it down very well. I could make up scenarios and stories that fit almost any of the lines that you might want to draw between these boundaries and others. So what does that mean? Well, I've already been through these points, so I want to concentrate on the final one. We need to recognize the uncertainty and to decide to pin down with great accuracy the deficit that we might have a small number of years ahead, set in isolation by a chancellor without discussion, may I say, with experts and others who understand the impact on parts of the economy from expenditures and also the need for a sustainable set of policies, I think will ultimately be very problematic. We really need to think about setting out a medium-term framework for fiscal policy that we're looking at on a well-recognized timetable in which both revenues and expenditures are assessed, as well as statements about the likely path of the instrument, which is the fiscal primary surplus, which can be changed depending on the circumstances, but at the same time, when you change them, you explain why, and you give a very good set of explanations as to why and when that fiscal instrument will be used. Unfortunately, we haven't got that at the moment, but I think the uncertainty we're currently confronting in the economy and the desperate times we face mean these sorts of structural framework reforms, I think, would be very helpful in affording us the level of flexibility we will need to deal with the uncertainty that we will continue to have to confront. Thank you.
Well, thank you very much indeed, Gary, Carl and Jagjit. A fascinating set of presentations which have elicited already a pretty substantial number of questions. Let me start with what I think is one of the more straightforward ones, and we'll come to the increasingly difficult ones as we go through, and no doubt more people will send some in. I think I'll chuck this one at you, Carl. Have you modelled a return to normal interest rates on the debt servicing requirement, and what will be the impact if we did get back to normal interest rates?
So that's not something we've explicitly quantified, but I think when worrying about what an increase in interest rates would do to the public finances, you really have to think through, well, what is it that would be causing that? What would be happening at the same time? So if we saw an increase in interest rates, an increase in debt borrowing costs for the government, that at the same time was associated with much stronger growth performance and much stronger outlook for growth, well, we'd end up spending more on debt interest, but we'd also have much more revenue coming in. The tax system would just deliver more, and therefore actually the public finances would be overall stronger, and that would be a much better world to be in. Clearly, with elevated debt, the risk that we're taking more of, and what we will almost certainly have to live with for many, many years, is the risk that interest rates rise, and that's not associated with stronger growth, which is the kind of scenarios that perhaps the worst case scenario that Jagjit was setting out in that chart on debt dynamics at the end. So it's not increases in interest rates that we should be worrying about, it's increases in interest rates which are not coming alongside stronger growth. And indeed, we've seen kind of the reverse to all of that happen over the last decade. We've seen debt borrowing costs fall. We've seen the amount we're spending on debt interest be much, much lower than we previously forecast, despite having a lot more debt. But that's not been good for the public finances because it's been associated with much weaker GDP and therefore much weaker tax receipts.
Great. In my position as chair, I can obviously send the difficult questions to Gary and Jagjit. So there's a question here not about what happens if interest rates rise, but a question about what will happen to interest rates. From Eric Albert from Le Monde, basically saying the bankers talked for years about interest rate rises, they haven't risen. It would now be pretty disastrous for the economy if they did rise. Doesn't that mean they are going to stay low for a very long time? Jagjit, would you like to try that one? Or?
Well, I can see Gary nodding, but the bank's remit is to hit its inflation target, subject to maintaining financial stability and supporting growth when it can. Interest rates will rise when the economy can bear interest rates rising. Interest rates are where they are because that's where the economy can bear them. So yes, I mean, at any time, the MPC would be ready to raise interest rates if it thought there was a sustainable inflation on the horizon that damaged its ability to hit inflation in the long run. That hasn't happened, so it hasn't had to raise interest rates. And I think the answer is very much related to Carl's point. It depends on the structure of the economy, the shocks that are hitting the economy, and whether we think the bank can hit its target or not. It hasn't had to raise interest rates because the economy doesn't look as though it's entering an inflationary spiral. So
can I just add on that? I think, I would say that real interest rates are determining global markets, and in a sense, the bank wouldn't have much choice really if rates went up everywhere else, that they would have eventually to put them up if they wanted to keep free capital moving. So I mean, the only alternative would be if the economy was such a bad position that it couldn't bear even slightly higher interest rates. I think you'd have to have reimposition of capital controls to prevent that, because otherwise it's we don't have a lot of say over what happens in world real interest rates.
So there's another question here about debt, which I think speaks directly to your presentation, Jagjit. It says, who will own the debt going forward? And what does it mean that the Bank of England owns such a large amount? And what will be the impact of that on the economy? So do you expect the ownership of debt to remain roughly as it is going forward? Will that change? And how much does it matter that the bank has such a large chunk of it on its balance sheet?
So the new person on the horizon since 2009 owning debt is the Bank of England. It's its own, and that was always thought to be a temporary measure. So temporary change in the amount of debt that the non-bank financial sector had to hold, and that allowed term premia to be lower than they would otherwise have been. It's very, very likely, given the economic research out there, that costs of financing would be some 100 to 150 basis points higher had the bank not decided to relieve some of that debt, at least temporarily, from financial markets. Now, I think at the time it was thought to be temporary. I think many of us thought it would carry on for a generation. Indeed, 10 years or so later, it has been a generation holding of debt. But the debt is rolled over when it expires. The bank goes into the market again to hold the debt. And it's to be thought of really as a way of affecting some control over long-term interest rates that it cannot do because bank rate can't go sufficiently negative to stabilize the economy. So if you imagine a world in which the short-term interest rate could be lowered even further, then that would reduce long-term interest rates. Because that can't be done, interest rates are, broadly speaking, bounded at zero. You've gone into the long end of the market to affect long-term interest rates, and that just helps stabilize the economy. So I see this still as ultimately a temporary purchase. It's a long-run temporary purchase, but it's a temporary purchase. If we go to other holdings of debt, I think there's further downward pressure on interest rates has been affected by the demand for relatively risk-free assets across the world. There are savers out there who are wanting to hold UK debt. It's still an important player in the international debt markets, and also for regulatory reasons. Many financial institutions want to hold public debt as well. So I see that structure staying very much the same, with the bank looking to exit from QE when and if it can. And that goes back to the question earlier on as to when the economy can bear those higher interest rates.
Great. We've got a question here from Martin Wheatcroft, which he says, aren't we being a bit complacent in comparing debt GDP levels with previous generations, given our many liabilities, pension liabilities, nuclear decommissioning, and so on, and the fact that we have a bigger welfare state and large unfunded commitments and an aging population and so on? If you look at all of that, maybe we look in the most indebted position we ever have been. So, I mean, were we all just much too cheerful?
Sorry, Carl, please.
So it's certainly the case there are lots of liabilities and commitments that the government has racked up which are not included in public sector net debt. So public service pension commitments are one of the biggest ones. we also need to worry about the risks going forwards. Those risks may be bigger in some areas. So, for example, the risks of what climate change might do to the public finances are clearly bigger than they were in distant history. There may be some risks which hopefully are much smaller than they used to be, such as the risks of significant wars breaking out. So it's hard to say, I think, whether the public finances are in a more risky state than they were before. I think we know that we've got elevated debt. We know what risks are around that, as Jajit was setting out. We know we have an aging population. We know, therefore, that we do have to change policy to adjust for that. We're either going to have to accommodate the pressures of that aging population on public services and on the pension bill or not. And if we do accommodate it, that almost certainly requires some tax rises. So there is very much, there's lots that needs to be balanced out here. And I think actually many of those other liabilities, and indeed many of the other known costs like the aging population, do point to reasons why over the next 10 years, we may well see net tax rises coming along.
Do you want to add to that, Jajit?
Well, I was about to say, Paul, you're muted. We shouldn't ever let that happen again. I want to, if I may, just tee up Gary, because Gary and I have lots of discussions about whole of government accounts as a way of thinking about this, the whole of the government balance sheet. The nature of things is we always concentrate on this particular liability, which is this fraction of public debt. But of course, there are a lot of things on the asset side and a lot of forward-looking liabilities as well. And I think Gary has got some strong, reasonably strong views on that. I wonder if I could just turn to him as a way of nesting sort of things I was talking about as short-term instruments, but within this context of thinking more broadly about the whole of government accounts. Gary.
Well, yeah, I mean, I think that's right. I think it's just too narrow to look solely at debt. You need to look at the asset side and other liabilities as well. And I'm sort of pleased to see that the new appointee to the OBR is like. So I think, I think we definitely need to look at the whole of government accounts. And I think nevertheless, looking at debt in a situation where things are changing very quickly, where the other parts of the accounts are probably not changing so much, is probably quite a good sort of quick indicator anyway.
I'm going to chuck this one at you, Jajit. The question which you may need to explain to some of the audience is Stephanie Kelton wrong? And if so, why? And that question comes from Justin Thacker from Church Action for Tax Justice.
Yes, thank you. I think, unless anyone that's referring to modern monetary theory. So it's essentially this idea that the state can issue money either through helicopter drops or otherwise to boost income, providing inflation itself doesn't rise. And it's very much akin to the ideas of helicopter drops that are doing the rounds, so that in a world in which people are, without income, one way of delivering income to them very quickly would be to place, say, £1,000 in everyone's bank account or something along those lines. That would, the UK, be some £60 billion, some 3% of GDP. And these kinds of ideas crop up regularly on the circuit. The point about these kinds of ideas is that there is really whether the issuance of money in that way constitutes net wealth. It's a slightly technical point, but it means that if they issue the money and people treat it as net wealth, they will feel better off and they may spend the money. But on the other hand, if the issuance of the money is not valued, either because people think the state cannot match taxes for that liability, so it hasn't got sufficient tax revenue raising capability, and or these instruments will get used regularly and therefore devalue them, people will not treat them as net wealth at all, and they won't have the impact that people who've got these ideas in their mind will have. So there is a deeper question there about whether the stuff will get valued or not. And I think most of the examples that we have of where the state has issued unbacked fiat money, if we look at the chronic hyperinflations of the 1920s and subsequently in the 1940s and 50s, are that these do not end well. Much better to think about these as fiscal policies backed by future taxes that are placing money in the hands of people who need them, but through fiscal policy, not through a form of monetary policy. There's no point in using the bank balance sheet to mask a fiscal policy. So where we think, and there are households, we're terribly worried about the impact of this crisis on poorer households, those who've lost their jobs, and also on certain communities who felt more vulnerable to this shock than others. But that is ultimately a question for the Chancellor to think about the levels of income support and delivering them quickly to people. It's not a question for the Monetary Authority to consider.
So the questions are coming in thick and fast. We've got one from Chris Giles here at the FT. Is this a time for a stimulus to boost the economy? And what should it look like? Would lower VAT rates be a good part of that package? Do you want to kick off on that one, Carl?
Yeah, so, I mean, as I was saying, if there are things we can do now, even if they add to government borrowing, given the low cost of borrowing, if we're sure that they would deliver a stronger recovery, then they're almost certainly worth doing. I think a VAT cut is something I would probably keep in the locker for now. I think we need to see how, as the lockdown eases, how does supply respond and how does demand respond? If we see shops opening and there are queues outside of those shops, for example, a VAT cut's not going to help. The problem is essentially we need supply to recover, and there the policy really needs to be about the government setting out clear guidance on how we can ease the lockdown and making sure that it's doing that in a way that people can be confident about is safe, so they do start to return to the shops and follow those distancing measures, and the economy can start to reopen. I think if I was going to do some stimulus measures now, I'd perhaps look more on the employment side, maybe trying to encourage employers to keep people on or take people on. I'd be really worried about the possibility of furloughed workers becoming unemployed and that turning out to linger on for a long while. We know it can take unemployed people a very long while to get back to as good a job that they had before. There may also be some smart tax reforms that we would really like to do in the longer term that could become particularly attractive now if you're trying to stimulate the economy. These aren't necessarily the kind of things that would win you elections, but they are the kind of things that at least we at the IFS are quite keen on. So, for example, if you were so minded, you could abolish stamp duty on house purchases now and replace that with a reformed and strengthened council tax. So in the long run, you are raising just as much money. You'd find that would stimulate the economy now because house purchases at the moment would be lower taxed. All of the activity associated with that would be beneficial to the economy. And when we got through this crisis, we'd have a better tax system because we'd be taxing people more sensibly on the value of the house that they own or occupy, as opposed to whether they happen to buy houses more frequently than others.
I'll give Jagjit and Gary a chance to answer that with the last question that I'm going to ask. There's an anonymous one here. Perhaps you'll understand why. What about setting a higher than 2% inflation target? Well, what wouldn't that allow debt to fall over time, and why? What would be the downside of it? And a related question: should we have a nominal GDP target? So perhaps Jagjit and Gary could kick off with that, and any final thoughts.
On the nominal GDP target, to some extent, we already do have one, in the sense that if the inflation was turning out to be too low, put it another way, if output was falling below the potential level of output, then the bank would tend to allow higher inflation in those circumstances anyway, because it has, it's not a sort of strict inflation target, but it has flexible inflation targeting, so it can do that. If the economy is very slack, then it can allow inflation to be above target, even within its own current remit. So I think that's covered by that. First part of the question was going for a higher inflation target. Well, I think there are some grounds for that, but that would tend to lead to higher nominal interest rates if you did that, and so that wouldn't work to the extent that you had relatively any short-term debt you had that would get revalued into not high nominal rates wouldn't really help there. But it would obviously be bad news for those who'd lent to the government at lower nominal fixed rates. So, but it's a sort of distributional issue. Why do you want to take particularly from those people who'd lent you in the past in good faith that you would stick to your inflation target? So I wouldn't recommend it. I think it'd be better to be more open about it. If you wanted to tax those people, why not just levy a tax on them?
Do you want to add something to that, Jagjit? And any last thoughts?
I completely agree with Gary. I think you don't really want to mess around with price stability. Inflation at 2% is broadly speaking in line with price stability in the middle of a crisis as well. I think something that is stable and continuing to be hit is a good idea. And I think a lot of the thrust of what we're talking about is really for more active fiscal policy, more careful consideration, very much like Carl's idea about thinking about the housing market. It's obviously a very important driver of consumption in this economy, as well as an important source of dinner table conversations with everyone. So clearly it matters to people. So things that would help that along is important. Regional reform of the taxation system would put more money in the hands of local authorities who may be, as time goes on, in face of local lockdowns, having to deal with that, as well as having a better understanding of what really is shovel ready down the streets in which they live. And if they had a bit of money in their back pocket, they may be able to do those things, as well as to manage the schools, the health authorities and the police that we're going to need. So anything that helps that further devolution to regional authorities sounds to me like a very sensible idea. Thank you, that's all.
Well, it's probably time to end on that note. Stimulus for dinner table conversation is clearly much needed. We could clearly have another session entirely on the issue of devolution of tax and spending policies. But thank you so much to Jagjit, Gary, and Carl for what I hope all of you watching found as informative and interesting as I did. And hopefully we will be back with you with more interesting research and analysis pretty soon. Thank you all very much.
Thank you.
Bye.
Thanks, Paul. Thanks, Paul. Thanks, Gary.